Are you surprised to see the resilience of the market?
It is. It's almost as if they're whistling along the grave, the graveside on all the graves that we're passing. It really is hard. I know that there is a disconnect, and the economy is not the stock market, and the stock market is not the economy. But we've just never seen anything like this. As Rick just pointed out, the kind of monthly declines we're seeing would have been horrible annual declines in the worst of recessions. We're looking at retail sales down nearly 9% before we hit all of the state closings that we hit in March. We saw the production numbers, the worst on record. We saw, big declines in housing starts as everything came to a standstill, the deep freeze of the U.S. economy in an ice age, and the thaw will be much more slow and uneven.
So, Andrew, how does a portfolio manager navigate that picture Diane just painted with the optimism that we continue to see in this market, teeing off of some of the headlines around treatments and testings and vaccines and infection curves?
Sure. I think the important thing to consider is the stock market is a forward indicator. It fell off a cliff before it was apparent the magnitude of the shutdown of the economy. And I think the market is rallying in anticipation of the reopening of the economy. I think it's tough to get real optimistic near term as we get close to 3,000. But that's what's going on. The market is anticipating a reopening. And if you look at today, as much as I think the market's going to run out of steam here near term because it's now priced in this reopening, there's a lot of opportunities within underlying the market because the market has so favored the stay-at-home stocks that there is a huge spread of valuation between the stay-at-home stocks and the reopenings, as I would say, stocks.
So where do you see the biggest opportunities and dislocations, given, as you say, there's some real bifurcation here, even for the week, which was turning out to be a good one. Financials are down 5%, energy's down 4%, real estate, materials, these sectors are all lower for the week. Where are the opportunities?
In many that you just listed. Look, the most speculative stocks are obviously the travel leisure, and those, the ones that will survive, they'll be the biggest returns. I don't think you need to even actually delve down to that level. People are going to go back and buy a cup of coffee and go get a burger and go fix up their house. So I think consumer discretionary stocks that have been beaten down, some of the payment processing companies have been beaten down. I noticed today that 2 REITs withdrew guidance, and their stocks are up huge. I'm not recommending. I'm just saying that I think the pricing is substantial. So, the banks, there will be some near-term problems. But the point of all this is by the time it's clear that we are going back to, coming out of our house, these stocks are going to be up a lot, just like the market has rallied close to 30% off the low, even though we're still sheltering at home because the market is a forward predictor.
Diane, where are you and where is the street on the third quarter? I think everybody knows the second quarter is going to look terrible in terms of the economic data, a very sharp drop in GDP. What does Q3 and Q4 look like at this point?
Actually, the second half of the year is still a very rocky period, and I think that's where the markets are really not getting this in terms of the risk. Not only do we have draconian cuts at the state and local level, if we do not get transfers to the states, it's some $500 billion shortfall they're looking at over 2 years, twice as bad at least as the Great Recession. And we know that from the Great Recession, the reason we didn't have more of a employment recovery early on was the hurdles that were at the state and local level. We didn't transfer money to the states, and that's a headwind in the second half of 2020 and into 2021. So we're looking at flat if we're lucky. In the third quarter, we could have another leg down in terms of as we try to reopen, then we stumble if we have to have lockdowns again. Also, the rest of the world is not opening up synchronously. They're opening up unevenly, and we've already seen how that set back much of what's going on in China in terms of manufacturing. The global economy is not opening up in sync. Any subsequent lockdowns are going to set sectors back after they try to come back a bit. And so it really sets for a rocky, very narrowly positive positive second half of the year, you could have some weeks that look terrific and then a setback again. And I think that's the uneven nature that we are going into, and trying to apply old rules of thumb that this is just, even if the recovery looks strong, it's still not anywhere near the level of activity that we saw prior to the crisis. We think it will take over 2 years to recoup the losses we hit to this crisis to get the level of economic activity, and some 3 years, if we're lucky, to see unemployment fall back down to the lows we hit prior to the crisis. That's better than the Great Recession with a lot of stimulus.
Point, if it's 2 or 3 years before we get back to the same level of economic activity we had prior to the virus, why am I willing to pay as much as it would seem I am on a multiple basis for stocks right now?
I totally agree with that, and that's why I think the market is going to struggle as it gets close to 3,000, because what the market is going to fixate on is what is the right earnings for next year, not this year, next year. And as it gets close to 3,000, the market's trading at, kind of 17 times a reduced guidance, which we really don't know. I think that's how the market, to me, is going to run out. This rally is going to run out of steam here because of that uncertainty about next year's guidance, which will be, is continuing to come down.